Alright, so let's begin. Lack of financial literacy is the reason why a lot of investors fall prey to different kind of financial frauds or land up buying wrong products. Although, thanks to the financial markets regulator, investor interest and their protection is a non-negotiable at any cost. But having said that, due to a lot of information bombarding and influencers claiming to be market pundits and a few mutual fund distributors in an attempt to make a quick buck, often take advantage of market movements and lure investors to buying specific products, and in this case we are talking about mid-cap and small-cap funds that have seen this particular space has seen a strong run-up. Let's discuss this further with Aditya Agrawal, co-founder Wealthy.in. Aditya, good evening and welcome to the show. So whenever we discuss investor portfolio or our viewers portfolio these days on the channel, on the show, we see a lot of small-cap funds. In fact, people just have started investing and their first fund happens to be a small cap fund on the basis of the product maybe is being sold by someone to them, or they just see a surge in the performance or in this category. Having said that, there is information and there is something called as misinformation, and over here the misinformation part is slightly heavier when it comes to educating the clients, even from a mutual fund distributor's perspective. They are obviously trying to cash it out, and over here the investor is just looking at big returns. How would you explain this entire scenario, Aditya?
Thanks, Kavita. Pleasure being here. So you're absolutely right. I can explain it by a simple example. When you're buying a new phone, we can very easily compare that, okay, the camera is how many pixels, the battery life is for how long, what is the weight of the phone. So there are very clear-cut, specific facts that help us choose a product. But when it comes to investment products, unfortunately, the only thing we have is past performance, right? So that is something that I can, as a consumer, see, okay, what is the performance for past 1 year, 3 year, 5 year, right? I can't predict what the future is, but I can see what is the past. What happens majority times, right? And it is not just about if a consumer is buying through a distributor or his consumer is investing on their own. Majority times we end up looking at what gave the best returns. And that is not just in mutual fund, across products. But the reason why you are seeing small caps in your portfolios, or even first investment of a client is small cap, is because, in last 1 year, most majority small cap funds have delivered 40% plus return, right? So when you see a number like 40%, you obviously get excited and you forget about what can go wrong. You only focus on the fact that, oh yes, I can make 40%. That is like almost 1.5 times more money in 1 year, which, probably no other instrument can give. So that is the starting point of why a lot of people end up getting wrong and sort of go into a product which may not be suitable for them, but they just look at one parameter, which is last 1 year return, and not able to look beyond that. That is the primary reason, Kavita, why this happens.
So the way, these products are missold, not to take it wrong, one can really have a mid-cap and small-cap in the portfolio, depending on the way the portfolio is designed and the way it's been diversified. And accordingly, one can have the exposure restriction or maybe plan it accordingly. But then a lot of banks that push mutual funds, there are a lot of distributors or even experts who try to compare the performance that's been seen right now in mid-cap and small-cap to something like a fixed deposit, or maybe to a debt mutual fund where an investor, will see less volatility or much more safety as compared to these categories. These comparisons which are shown are wrong, obviously. Also, from the investor's point of view, and the fact that they need to understand is the kind of space that you're talking about, which has high volatility. It's high risk and high return kind of a space, which you need to understand. How would you actually analyze if you're being sold the wrong kind of product?
Right. So I think first, if I have to look at when someone is recommending me a product, if someone is only talking about returns, right, and if someone is talking about high returns, then that's the first red flag for me, right? Because if I'm speaking to someone, if I'm not sure about a product, especially if it's investments, people should be talking about, what my ambition is from my money, what my aspirations are for my family, right? And how can my money take me there, right? But if the conversation about a product is about returns, then that is an immediate red flag, because then I should at least go deeper into it, right? I should ask question that, okay, in last 10 years, in last 1 year, you are saying 40% return. But if you look at last 10 years, how many years are there where it has consistently delivered 40%, right? So, because then at least that will make me understand that, okay, this 40% phenomena only happens probably once or twice or thrice in 10 years, right? There are also times when it actually falls by 40%, right? And no doubt, small caps are a great investment, because if you look at the growth of money in small cap index versus a large cap index, it's almost twice, difference is of 2 times. My 100 rupees invested will probably become in 20 years, like maybe my 1,000 rupees will become probably 41,000 rupees in small cap, whereas my 1,000 rupees invested will become 22,000 in large cap. So the returns are definitely there, but the returns are not for person or an investor who is coming just because they want to earn another 40% in 1 year, right? That is not going to happen, because a lot of people who made money in small caps are people who consciously chose small caps as the part of their portfolio, and only then they were able to see that return from their portfolio. So when you're analyzing, when someone is speaking to you, I think that if someone is speaking about high returns in last 1 year, I think that's the first red flag. Obviously, the second thing that you should analyze is that how does this product fit into your long-term financial goals, right? If your ambition is to double money in 1 year, like no financial product can do that for you, right? But if your ambition is that, okay, my money can grow at a faster rate than, let's say, a bank fixed deposit or a stock market, then definitely small cap is a choice for you. But you should also then understand that what goes up, as you rightly said, what goes up so quickly can also fall down very quickly, because volatility is huge in these small caps, right? I remember 2017-18, people were investing in small caps, and it gave 50% return in 1 year, but the next year, people lost almost 50% of their portfolio value, because suddenly small cap was out of flavor, right? So that's how you analyze your investment, especially when someone is speaking to you about these financial products.
And specifically, if someone tells you that your money will be doubled in 1 year, it's an equity product, you really need to understand, be it a small cap, mid cap, or even a large cap category. 1 year is not a time horizon for you to be investing in equity via mutual funds.
100%. I think you have to understand that, this is an asset class which will grow because it is linked to the growth of economy. But in short term, you can't predict its behavior. It's like, I think one famous dialogue that is there is that, if I'm taking my dog from my home to my library, right, or my office, I know eventually we'll get there, but what exact path my dog will follow each day will probably be different. So that's, I think, very similar to equity markets, that eventually it will give you 12-15% returns over a long period of time, but you will not get it every year. But over a long period, yes, you will get that 15% kind of compounding from equity investments.
So also, now do you think it's a time to maybe reduce exposure in mid cap, small cap? I mean, even if it's a part of your portfolio now, in whatever way you have placed it, and if you're really heavy on it, you think certain amount of profit booking can be done?
Right. That's a great question, Kavita. In fact, a lot of people struggle with that how do I decide what to exit and what to sort of keep? So the way at least we look at it is that, let's say you decided that you will invest 100 rupees in equity, and you decided 70 will be in large cap, 20 will be in mid cap, and 10 will be in small cap. That's what you want to keep your allocation, right? Because that is something that you're okay with. 10% in small cap, you're okay with the returns and risk that it provides. Now let's say market ran up really a lot, right? And let's say small and mid cap and large cap remained the same, but your 10 rupees in small cap became, let's say, 15, right? So now your allocation is kind of disturbed. So the one way to look at it is that you can sell as much small cap so that your allocation again becomes 70-20-10. That's one compass to use. Otherwise, it's very difficult when to get in, when to get out. So the best way is to decide that, okay, in long term, I want to keep 70, let's say in large cap, 20 in mid, and 10 in small. And then if, let's say, there is a profit run or there's a run, and it will actually work other way around as well. Let's say if there is a market crash and your small cap from 10 becomes 5, and if you're investing more money, probably it's time to put it in small cap, because you're getting into, because your focus is that I will get back to that 70-20-10, because in long term, 70-20-10, I'm very comfortable with the kind of risk and return it provides. So to answer your question, whatever is your decided mix, like 70-20-10 is a great mix to work with. If your profits have risen so much that the 10 has become in small cap become 15 out of the total portfolio, you trim so that you get back to 70-20-10.
All right, so that's the way one should be looking at mid-cap and small-cap space. Thank you so much, Aditya, for being on the show and helping our viewers with this. Time for a quick break, but then post that, let's talk about your life post-retirement. How can you ensure that whatever money you've invested for your retirement purpose is utilized really well? And what about your career? Can you really have a career post getting retired, especially after 60? All of this and more after this break. Welcome Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Post-retirement time is a tricky time, especially when people are living longer. Nowadays, the post-retirement people are living for almost 2 to 3 decades and even more if follow a very healthy lifestyle. Health conditions might vary though. But what's important is the right use of money that's been earned during the lifetime, and that will be put to use during this period. Now, how can one ensure that their investments keep making money for themselves? What are the career alternatives one can look at to ensure that this phase of their life is taken care of? So let's dive deep in this conversation with Arnav Pandya, founder Money Edu School, and Dr. Pratibha Jain, MD EduBoard Consulting India. Good evening and welcome to the show. So Arnav, post-retirement life, a very crucial time and also a time where one needs to figure out the rest of the time, especially if they don't have any particular regular income. This is the time when you actually dip into your investments that you have done all your working life. So especially talking about someone who is retiring post 60 and has planned a typical kind of a lifestyle where there is no regular income. Basic fundamentals of retirement planning would be that you have the right kind of investments done already when you were working, plan for your retirement and plan it early, etc. But then when you're already retired, what kind of modifications and changes one needs to do in their investment portfolio, say if one has a completely equity oriented and a bit of debt oriented portfolio?
Good evening, Kavita. So, whenever we think of retirement planning, the focus of most people is on the accumulation of wealth till the time of retirement. But it's very important to look at the next phase, which is the distribution part, wherein the amount which has been accumulated, you are going to use it over the next 2 or 3 decades after retirement. So, if you have a largely equity portfolio which is there with a small mixture of debt before retirement, you need to convert a part of it into various other assets which are in tune with what your requirements are. So let us now look at what is the main requirement of a person who has retired. One is a regular cash flow which comes in, which meets the various expenses which are there. And then there should be a corpus which is good enough so that it lasts for the entire lifetime. So the idea should be that there should be a part of the corpus which gives you a regular rate of return, and there is also an element within the portfolio which is able to ensure that there is some growth available so that the money doesn't run out before the requirements run out. So that is very crucial, and which is why once you are retired, there is going to be a significant part which is going to be in debt. But at the same time, there has to be an equity component. You might even look at various other options which are now available in the form of REITs or even gold as a mixture, as a part of an overall portfolio mix.
What can one actually do to calculate the expenses post-retirement? Because this structure also changes and so your budgeting would also change, Arnav?
Definitely, because see, when you are looking at your expenses before retirement, there are a part of your total expenses will be related to work, because it could look at things like conveyance or eating out. Out, when I say, it's not the outing with the family, but when you are at work, maybe you have to spend some amounts to eat while you are at work. So these kind of expenses, conveyance, traveling, all those things related to work, those will not be there. But at the same time, as you grow older, two expenses which are very significant. One is related to medical expenses, medical costs which are there. And the second is related to running your households and what actually constitutes there, because various food items and other things, those two become primary parts of your budget, and that needs focus. So you need to ensure and check as to what your new budgeting amount is and how much do you require as terms of a regular payout or a regular cash flow, and then decide as to how you're going to structure your portfolio.
Pratibha, coming to you, can one really have a career post-retirement?
Oh yes, today careers, retirement is actually second innings.
Okay.
And I can speak, I'm also plus 60. And I think the second innings is much better than the first innings, because one is free from a lot of compulsions and freedom of financials, especially if you've invested well. And I see so many people doing wonderful things with their retirement. One, we have skills which are extremely valued. We have problem solving, managing challenges of every kind, diversity of people. And this is valued by, you can be an entrepreneur, and startups are valuing the wisdom that senior citizens or professionals with experience bring to the table. So there is a good mix of young people who are, energized to do new things, and the wisdom, the anchor that a experienced person brings. So both the startup culture is huge, self-entrepreneurship, strategy and consulting has become again a very big role where you can design your timings. You're not fixed to an 8-hour day, 10-hour day. You can be a consultant. And many organizations value again the ability to think of the future and plan for pitfalls. Sometimes people on the job are not able to visualize what could go wrong. And that is one huge area. And I think training and education. Government of India, the new NEP policy allows professionals with experience to be now full-time lecturers. So that is, I think, a huge value add to the education workforce, where profession and experience, imagine bringing them into the classroom, mentoring young people, especially finance and the professional programs brings huge value add. And many senior retirees are actually now learning. They become learners and expanding into areas they always wanted to do. So I have a neurosurgeon who's actually doing learning music, and he's become a DJ production because in his growing up years, he didn't have time to follow his passion. So consulting, working, entering into a completely new area. And another very big value add has been heading or, channelizing a large funds which need experience and wisdom. I know a lot of people, the India Development Foundation, the Roti Bank Foundation, Teach for India Fellowship, a lot of these large ticket philanthropic organizations are also, it's not that I'm doing a favor, they're actually welcoming professionals who have retired, because you bring a sense of integrity, a certain sense of stretching every resource, which is part of the DNA of a senior manager.
What about,
and those skills are valued.
Right. So, but then Pratibha, experience is there, definitely, okay? But what about the money?
Oh, they're well paid. Okay. Today, a consultant can be paid for his experience. These are paid positions. These are not philanthropic positions. And they are paid depending on the experience. And obviously, if I want to be part of welfare organizations, I may not want a corporate salary, but they're paid decent wages for the wisdom they bring to the table. Now, nobody is looking at, oh, I could be a philanthropist. That is definitely an option. But many organizations are today valuing the only freedom is I'm not bound to a desk. I'm not bound to an 8-hour, 10-hour job. The professional can decide the work hours he wants to do and accordingly charge the company.
So now, talking about the concept of retirement, Arnav, that is also changing. People are also interested in having early retirement. Now also, the example Pratibha also gave, that one of the gentlemen is actually pursuing his passion and then maybe trying to monetize it professionally, and is already taken retirement from what he used to do earlier. How can one strategize this aspect of the retirement career, where you are also investing in maybe your hobbies or something that you always wanted to do in your working life and you couldn't find time? You're investing in that, and at the same time you want to monetize it later on. How can one strategize this? Because there is money again going into something that you might look at it as an investment, but then not necessary that it might result out in the way you want it to be in terms of investments and profits.
So this is a part which one has to do slightly before retirement, because what happens is that when you are planning your retirement finances, apart from the factor that you need a corpus which will ensure that there is income and money for you when you need it, a part of that also has to be directed towards these kind of activities where you might need to invest, because after retirement, you might do different kinds of things. If it's just a simple activity where you are either consulting or doing something with some other firm which doesn't require an investment, that is one part of it. But wherever there is some sort of entrepreneurial activity or it requires some investment into some assets, that will require a certain planning, because your overall corpus needs to factor this point in, because it is going to be an extra amount which you need to have planned for, because you can't use these kind of amounts from your corpus which you had thought that this is the amount which I'm going to use for my retirement income, and then start taking away chunks of it for different uses. So if you have done this kind of planning, then there is no problem whatsoever, because you know exactly how much is available with you, how much you can put in, and that becomes a very smooth affair for you to manage.
Pratibha, how can one look at early retirement? Pratibha?
Early retirement is actually now planned. I know many people.
Exactly, definitely. It should be, even if it is not, it should definitely be planned.
And it is more when people want more than one passion, or have, especially I've seen filmmaking, music, even art, designing. People then look at travel as I have a finance investment banker who's now well taken care of, and now he's becoming a chef, he's learning culinary arts, and is actually not just, he's running a cloud kitchen. So it's not that I'm doing a time pass passion. Early retirement is then planned that, look, after 45, this is the next second innings of my profession, where I'm a little free from financial anxieties, my family is taken care of, or my needs are taken care of, and I can follow my heart, I can follow my passion. And more than ever before today, people are saying, I don't need to give up. I may love two things. Why should I give up one for the other? I could be as passionate an investment banker and as passionate a musician or a filmmaker.
Right.
So that is now the reason for people want to travel, people want to see the world, people want to learn new things. Again, learning has become a huge area of endless, limitless, boundaryless learning. So people are now actually thinking that, look, let me make the most of my intellect and living life, and not just be tied to one career.
Post-retirement life actually can be, or the way Pratibha is also putting it down, your second inning can be way better than your first inning also. Definitely, one needs to plan it really well. Thank you so much, Pratibha and Arnav, for being on the show and helping our viewers with this today. We slip into a short break, but then post that, we will talk about your financial portfolio and get your mutual fund related queries answered after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. A lot is happening in the financial landscapes month that might have an impact on your money wallet. My colleague Bhavya Dua is here to explain the changes in the financial landscape this month. Let's listen in.
Interest on home loan rates, investment in special high-rate FDs, and the multiple things to take care of regarding your ITR even after the deadlines has been passed. A lot is happening in the financial landscape this month that might have an impact on your money wallet. Now let's take a closer look at what these are. Number 1, we might see an increase in interest on home loans. On July 26, the US Federal Reserve raised its benchmark lending rate to the highest level since 2001. Economists feel that this might lead to an increase in repo rate in India by RBI, and if the RBI hikes interest rates, banks will once again increase interest on home loans and other loans linked to the repo rate as an external benchmark as per the terms of the loan agreements. Next point to look at is that it might be the last chance to invest in special high-rate FDs. With the hike in repo rates since May 2022, several banks started increasing their FD rates and also introduced special FD schemes for specific investment tenures targeting regular and senior citizens. Now, August may see several newly launched FD schemes from select banks being discontinued. IDBI's bank's Amrit Mahotsav FD new scheme of 375 days is valid up to 15th of August. The last date to invest in SBI's Amrit Kal FD scheme is 15th of August as well. Now, Indian Bank has also special term deposit schemes named IND Super 400 days and IND Supreme 300 days. The last date to invest in these schemes is August 31st. These schemes are offering an interest rate in the range of 7.1% to 7.8%, and August may be the last month to lock in your investments in these special FD schemes. The next point to remember is do not forget to verify your return in August. After filing your ITR return, you need to verify it before the income tax department takes it up for processing. You can verify the return online through an income tax e-filing portal using your Aadhaar, pre-validated bank account, demat account, and so on. You need to verify your return within 30 days from the date of filing. The next point to remember is you may have to pay penalties for belated income tax return. Did you not file your ITR by 31st of July? Then be prepared to pay a penalty for filing belated returns. A belated return is a return that is filed after the due date mentioned in the income tax rules. The deadline for filing ITR is 31st of July, but one can still file returns until 31st of December for the financial year 22-23. But a penalty of Rs 5,000 will be charged for delay in filing returns if the total income to be reported exceeds Rs 5 lakh. And if the total income of the person is less than Rs 5 lakh, then the penalty is payable up to Rs 1,000.
All right, so these changes that will impact your pocket in the month of August. We move on. There are plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Manchus Question, Morningstar Investment Advisor India. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 8657974571. You can also email us your queries on the Money Show at etnow.tv. Hi, good evening, Himanshu, and welcome to the Money Show.
Hi, Kavita, thank you.
We are also joined by our first viewer on the phone line, Ritika Singh. Ritika, hi, good evening. How are you doing?
Hi, I am good. How are you?
I'm doing good. You're calling from where, Ritika?
I'm calling from Kolkata.
All right. So, as per the details sent by you, you're 24 years old and you want to start your journey in equity mutual funds. First of all, congratulations for thinking about this. And you're very young, in fact, the right age to start your investment. And I believe you're working? You're a working professional?
Yeah, actually, I'm a freelance copywriter.
Freelance copywriter. Oh, lovely. Any hit copies that you've written that we might just want to know about that?
I've written a few copies for website copies for Vassar and Constantine. If you would like to check that out, it's there on their website.
Definitely. Oh, wow. We are almost talking to a celebrity then. Okay.
No, not at all.
You want to invest 500 to 1,000 rupees per month. That's very nice. And you also wrote that it's going to be a long-term investment for at least 10 to 15 years. Right. Anything specific in mind after 10 to 15 years? Do you have a financial goal, or is just wealth creation and you just want to begin, just start off with this journey?
I just want to start off with this one because it's just I'm beginning here, so I would like to begin with a very minimum amount, so I don't have to risk much of it. So that is why. Okay. So I believe you read about equity mutual funds. You read about stock markets. As I told you, I am beginning with this thing, so I know a few things about it, but well, it is a huge ocean, so
Definitely. It is, Ritika, and thank you so much for sending us your query, in fact giving us an opportunity to help you with your financial investments. Himanshu, how will you help Ritika in starting off her journey?
Yeah, Ritika, frankly speaking, you still know the basic tenets of investing because given your query, you are for long-term focused, you want to start with SIP. These are the basic background, these are the basic foundation of to start investing with, and you clearly know all about that. So I would really like to commend you for, thinking that way. Frankly speaking, it's a good start. Even thinking in the right direction is a good start. And I'm very sure that you'll be able to invest wisely and create a long-term wealth for yourself. Since you are starting early, I think the best way to go about to do it is in the proper financial planning way, which is setting up the investment goal, setting up your investment objectives, doing asset allocation, selecting the right funds for your portfolio, and conducting regular reviews. Now, these are the basic format, or this is the basic path for investing. But I do understand that you want to start with investing rupees 500 to 1,000 rupees, which is also very good just to test waters. I think there are three solutions that I can offer you. One of the thing is, since you are starting, you can consider investing in an aggressive hybrid fund. Now, these are those funds which invest 65% to 80% of their assets in equities and balance 20 to 35% in debt instruments. That way, the category provides you a standard asset allocation. So as an investor, you don't really have to actively manage asset allocation. And it's a good starting point nonetheless. Some of the funds that you can consider from this category are SBI Hybrid Equity and Kotak Equity Hybrid. Another option that I would like to suggest you, for example, if you don't want a debt allocation in your portfolio, you might have some cash in your bank account, or you might have some FDs lying, or even if you don't have that, you want to go all out into equity to start with. So I think where you can start is to invest in a large cap fund. These large cap funds are really stable in nature, so they prove to be an anchor's role in a portfolio, in an investor's portfolio during turbulent times, given the stability that they provide. In my opinion, they should be the major portion of the portfolio whenever you start building your portfolio. So some of the funds from the large cap category that you can consider are Aditya Birla Frontline Equity, Axis Blue Chip, ICICI Prudential Blue Chip, Kotak Blue Chip, Mirai Large Cap. There are quite a few good large cap funds available in the market, which you can consider investing, managed by very well and experienced managers. Now, I'm not sure whether your income falls into the taxable bracket or it's a taxable salary. I'm not sure about that. But if it is, then also you can consider investing some portion in tax saving funds, which will help you save tax under Section 80C. That is something that you have to decide. So these are some of the options that you can explore, and you can see where you fit in, and accordingly you can plan your investments. So this is the starting point as of now. Now, what I would recommend is, as you progress in your career, you progress in your personal life, you have more money to invest. I think this is where you should start building your portfolio, and you keep on aligning your portfolio in line with your needs, investment objective, with the right asset allocation mix. That is very important. And the focus should also be on diversification. So going ahead, once you have more money to invest, you can start diversifying your portfolio and align this portfolio with one of the investment objective or goal. So you have target in mind. That is very important. Otherwise, a targetless investing is like, means it may not lead you anywhere. So assign your targets and assign those targets with the portfolio that you are building. And I think that this should help you going ahead. And that's the ideal way of investing going, obviously.
So that's the word coming in for you, Ritika, and all the best for your investment journey. Himanshu, we move on and we will take Samikshas question. And she says that she's been investing in SBI Small Cap since last year, and the fund has been underperforming as compared to its peers like Nippon Small Cap, and she wants to understand if she can still stay invested in this fund. The time horizon is long term for her.
Yeah. As a long-term investor, Samiksha, you should understand that every fund has a cycle. It goes through a cycle. Every fund is run with a strategy. Every manager has a different investment style, investment approach, and there will be times when that style or that approach or that strategy may go out of favor, and it may not deliver returns in line with our expectation. That's okay. If the underperformance is due to anything fundamentally not wrong with the fund, if there's something fundamentally wrong, then it's something that it requires obviously a relook. But if there's nothing fundamentally wrong, then I think you should consider investing in a fund. In case of SBI Small Cap Fund, I don't think there is anything wrong there. The fund is managed by a very experienced and veteran fund manager. His name is R. Srinivasan. He's one of the most prominent managers in the Indian mutual fund industry and expert in mid and small cap investing. He's supported by a team which is equally strong, and it comprises of experienced managers and analysts. Even if you look at the investment strategy, it's quite robust. The manager runs the portfolio with a bottom-up approach. He shortlists companies that can generate high growth on a sustainable basis. So obviously there is a quality bias as well as there is some growth bias out there. So these are fundamental attributes of the fund which has remained intact for a really long period of time. Obviously, there are certain risks given it's a small cap fund. It could face liquidity issues in some of its holdings, which are less liquid in nature. So during market downturn, when there's challenge to the liquidity, the fund may witness some challenge. But at the same time, if you look at the history, it has a long history, and it has seen all those cycles, it has come out of it and has performed well as well. However, to manage, one thing that I would like to point out here is to manage this risk, the fund house has actually stopped or restricted flows into the fund. So that is a very investor-friendly move, in my opinion. Now, while looking at a performance, you should also understand that performance is just one factor, but it's not the only factor. It should never be the topmost factor to select a fund. The fund should have a strong manager, team, and well-defined and robust investment strategy, which has weathered a test of time. These are the foundation of a fund, and if these things are in place, then performance would follow. But when I check the performance of this fund, and the performance of this fund is not actually bad. Obviously, in the recent times, it might have faced some challenges, but over a long term, and that's what the ideal time frame that you should be looking at for this fund, the performance is good, and it has been able to outperform the benchmark index as well as category peers. So I would recommend you to stay put in the fund. There is no need to panic or redeem your investments. However, from the diversification perspective, going ahead, if there's a need in your portfolio, then you can add another small cap fund just from the diversification perspective out there. Now, here's a piece of advice for you before we move to another question. Comparing your investment with the top performing fund in the category is like inviting disappointment. So you should also know what is the right comparison for the fund or how the fund should be compared. If a fund has been able to outperform its benchmark index and category peers over a longer period of time, and that should be fine, and that is the ideal way of doing it. So equity funds, also looking at equity funds from a 1 year perspective or the performance over a 1 year perspective and taking decision based on that is not a prudent approach. So be long-term, try to understand whether the fund is fundamentally sound or not throughout your investment journey. And if it's fundamentally sound, if it's doing the same thing that it has done in the past, then I think underperformance would come at times, but over a long term, the fund should be able to deliver outperformance.
All right, so for now, you can stay put in the fund. We move on, Himanshu, and we will take Lokesh's question from Bangalore, and he has invested in SBI Contra Fund for a long-term purpose, and mainly 10 years or so is his time horizon. He wants to understand if investment is good for him. Obviously, we need to know what kind of portfolio he has, but then just talking about this fund, what kind of investor should be putting this fund in their portfolio, and what is this fund like?
Okay, I'm not sure whether Mr. Lokesh has a portfolio intact or not. If it's not, then ideally he should invest in regular diversified equity funds from other standard categories like large, mid, small, large and mid, flexi cap, multi cap. The reason is contra funds are kind of theme-based funds. They are thematic funds which follow contrarian investment style. And what is that? These funds focuses on companies or sectors that are normally overlooked by investors and are available at reasonable valuation. So if in a well-calibrated approach, if the strategy does well, if it manages investment call goes right, then they may generate a strong return, but at the same time, risks are equally high. But if you have a portfolio in place, then from a diversification point of view, an investor can have some portion in these funds, but these funds cannot be a part of your core portfolio. They can be a part of your ancillary portfolio or satellite portfolio, but not a part of core portfolio, given the risks that are involved, given the seasonal kind of nature that these funds tend to have. Now, if we look at the contra category, there are just 3 dedicated contra funds, and SBI Contra Fund stands out within that. So if Mr. Lokesh doesn't have a portfolio in place, then I would recommend not investing in SBI Contra. He should rather go for a regular way of investing. But if he has a portfolio in place, then he can consider investing some portion in SBI Contra Fund. The performance has been good. So that way, I think that is how I would recommend how he should approach this investment.
We will take Danish's question, and he wants to invest for 6 to 8 months where he can get under 10% return.
I think he has a very specific requirement of 6 to 8 months as an investment horizon. So obviously, equity funds are certainly out of question. So they are completely ruled out. the best way to go about investing in this case is selecting some of the fixed income categories which have less than 1 year of investment horizon. For example, funds from ultra short, low duration and money market, and that will be more suited for him. Some of the funds that he can consider are ICICI Prudential Ultra Short Term Fund, Axis Ultra Short, Kotak Savings, SBI Magnum from the ultra short category. From the low duration categories, ICICI Prudential Savings, SGFC Low Duration, Kotak Low Duration. These are good funds. Even from money market, SBI Savings, Kotak Money Market, Axis Money Market, these are some of the good funds that he can consider investing. As far as return expectation is concerned, it's very difficult to predict. However, by investing in these categories or in these funds, his risk will be on the lower side and he will be able to reach closer to the target return that he is aimed for to achieve. So I think this is how he should follow. I don't think there's any other better way of going ahead in this kind of a situation.
All right. So talking about investment for such a short period, the focus should be on earning returns or maybe just having your capital secured?
Capital secured. I think capital security is one of the best, one of the things that over a short period of time, one should focus at. And that's why we don't recommend equities, largely because, the last 6 months or 7 months have been great for equity, but who knows what lies ahead. And there, the chances of capital erosion is much higher. Unlike in case of debt funds or these categories, where your capital will most likely be preserved, but at the same time, you will be able to earn some returns, which will help you achieve your return target. So I think in such a short period of time, if you want to invest, capital preservation should be the main objective of investors.
Wants to have a slightly longer or maybe medium term outlook in a debt category, okay, how would you recommend that kind of a placement in their portfolio looking at their interest rate scenario right now?
I think that way, if you look at short-term category and medium duration category are pretty strong. Medium duration category used to be a pseudo credit category earlier, but now the credit exposures have toned down quite a bit. Most of the funds take 20% or 30% of exposure in lower rated papers. So, but otherwise, if you have some risk appetite there, medium duration category funds are also good, and those lower rated papers provide a kicker to the portfolio where the returns could be relatively higher than the short term category. So I think short duration fund and medium duration fund, even combined together, will be a really good option for those investors.
Interest rate scenario, a longer term bet in debt mutual funds will not be a good idea?
I think there you need to invest. You can consider dynamic bond fund.
Okay.
We still are not very sure when we see an interest rate cut, although we have peaked. But as you see, we were expecting, a pause, a relatively longer pause with the US interest rate, but US Fed has just hiked rates, and that could also lead to RBI hiking rates. So we still don't know whether we are at the peak of the interest rate hike cycle or we have reached a pause. So in such an environment where there are uncertain times, you can't really take a call on a longer duration at this point in time, until there is more clarity in place. What one can do is one can invest in dynamic bond funds, which can manage their duration dynamically. They have better flexibility in terms of looking at the interest rate environment. The managers have more visibility out there, and they can reduce duration as well as high duration based on how the interest rate scenario is panning out. So I think that way, dynamic bond fund could be considered. But normally in uncertain scenario where you are not very sure how the interest rates would pan out in the next, say, 7, 8, 9 months, then I think being on a shorter side would be more a cautious kind of an approach, but more advisable at this point in time. Having some allocation dynamic bond fund would not hurt, just in case if there's a sudden change happens and and there's sudden chance of making some returns.
Manchu, there is no interest rate risk attached to dynamic bond funds. Is that what you're trying to say?
No, there is. That's why I'm saying that there is interest rate risk, definitely. But that interest rate risk is managed by manager, right? So a manager can go down to, say, 1 year or 2 year of maturity. But at the same time, if he sees there's an opportunity to make at the higher end of the yield curve, he can increase the maturity. So the interest rate risk is managed by the manager. Whereas in the short-term categories or something which is lower than short-term categories, the interest rate risks are low. But in dynamic bond fund, interest rate risks are high. Because here we are obviously relying on the manager that his investment call is going right.
Himanshu, I think that will be all. Thank you so much for taking time out today and helping our viewers with their financial portfolio queries.
Thank you, Kavita. Thank you for inviting me. Really
And time to sign off from the Money Show, but then we leave you with our WhatsApp number and our email ID where we keep waiting for your portfolio related queries. Thank you so much for watching. Goodbye.